Welcome back to the Deep Dive. Today we're jumping into the Greater Toronto Area real estate scene. We're looking at mid-2025, specifically Q2, and some of the latest August numbers.
Right.
And it's a really interesting picture, maybe even a bit puzzling. You hear all this talk about affordability getting better, maybe rates coming down finally. But then the market itself feels, well, kind of chilly, almost stuck. So yeah, let's try and unpack this.
Puzzling is a good word for it. And that's exactly what we want to do today, sort of cut through that noise, those mixed signals, and get a real sense of what's driving things. Understanding how these big international forces like trade connect down to what's happening locally. The goal is really just clarity, what's actually going on and what does it mean for you, whether you're thinking of buying, selling, or just trying to figure out the economy here.
And it's quite the landscape right now. Let's maybe start with the big one, the elephant in the room. These trade tensions between the U.S. and Canada seem to be casting a really long shadow.
They really are. And that's probably the biggest drag on confidence we're seeing. If you remember back in March 2025, things really escalated. The U.S. hit Canadian steel and aluminum with tariffs up to 50% in some cases.
50. Wow.
Yeah, and then a whole range of other imports got hit too, energy included. And, from the Canadian side, our digital services tax hasn't exactly helped smooth things over either. It's drawn a lot of criticism from the U.S.
Okay, those are some serious numbers. But what does that actually do? Like, what's the real-world impact on Canadian businesses, Canadian people, our wallets?
Well, the impact is pretty severe. You hear industry folks like Lana Payne at Unifor saying these tariffs are essentially killing investment, particularly in steel, aluminum, the auto sector.
Killing investment.
Yeah, think about it. Businesses delay big spending plans, maybe hold off on hiring, or have to completely rethink their supply chains if they export. We saw the numbers in April 2025, goods exports dropped over 10%. Motor vehicles and parts down more than 17%.
Ouch.
And for regular people, you're looking at potential price hikes.
Yeah.
Maybe 2 to 4% on appliances, an extra, $200 to $600 maybe on a new car. It adds up. And Canada, of course, we've retaliated with our own tariffs on U.S. goods. So it's this costly back and forth.
So you've got this intense trade stuff happening, creating all this uncertainty. How on earth is the Bank of Canada supposed to, steer the ship in this kind of storm?
Yeah.
Sounds like a nightmare.
It's incredibly difficult, yeah. And you see that in their policy. The BOC is being very, very cautious. They kept the overnight rate target at 2.75% in June and then held it again in July.
Right, after cutting quite a bit before that.
Exactly. They'd already cut 7 times since mid-2024, brought the rate down 225 basis points from that 5% peak. But now they're holding steady. And they explicitly said it's because of the extraordinary uncertainty from U.S. trade policy.
So they're basically saying we can't see ahead.
Pretty much. It's like driving in really thick fog. You slow down, you wait for things to clear up a bit before you make your next move. They're being, as they put it, less forward-looking than usual.
Makes sense, given the trade situation.
Yeah.
But how much is this uncertainty actually hitting people? Their confidence, their willingness to spend.
Oh, it's hitting hard. Dramatically, actually. You look at the Conference Board's Consumer Confidence Index. It just plunged to a record low back in March. 44.2.
Wow.
Yeah, and almost half the people they surveyed expected fewer job opportunities coming up. And businesses feel it too. The CFIB's Business Barometer, that's small business confidence, it also crashed to an all-time low. Ontario was actually the second worst province on that measure.
So it's like a psychological barrier almost.
Absolutely. It's a huge drag. People just aren't willing to make big commitments, buy a house, buy a car, expand a business when they're feeling insecure about the future, about jobs. And, if we connect this to the bigger picture, other numbers from around March to July sort of back this up. Inflation, yeah, headline inflation moderated a bit, but the core measures, the ones that show the underlying trend, still kind of sticky, around 2.8, 2.9%.
Okay.
Real GDP actually shrank slightly month over month back in February. The job market definitely softened. We lost about 33,000 jobs nationally in March. Unemployment ticked up to 6.7%. And even here in Toronto, employment growth year over year was negative as of July.
So, okay, just to sum up this part, we've got this really uncertain economy. The Bank of Canada tried to stimulate with rate cuts, but those trade fears and job worries are basically canceling that out. It's an odd mix.
It's a very unusual situation, yeah. The normal levers aren't quite working as expected because this external factor, the trade dispute, is weighing so heavily on confidence.
Which brings us right back to the Toronto housing market. How is all this playing out on the ground? What are the May, June, July, August numbers actually telling us?
Right. So the GTA market itself is showing that complexity. It's not one simple story. Sales activity, for instance, is kind of all over the place.
Okay.
Condo sales in Q2 were down sharply, nearly 21% year over year. Overall home sales in May were down too, about 13% from the year before. But then July actually saw pop sales were up almost 11% year over year. Best July since 2021, apparently.
Huh. Okay. Bit of whiplash there.
A little bit. August sales were also up slightly year over year, about 2.3%, but they did dip month over month if you adjust for seasonality. So, yeah, bumpy is a good word. Listings, though, that's a clearer trend. Up. New listings were higher year over year in May, July, and August. And active listings, the total homes for sale, they've really surged. Up almost 40% for condos at the end of Q2. Up over 22% for all types in August.
So more choice for buyer.
Definitely. Elevated choice is the term TR8 used. And that gives buyers more negotiating power, which leads us to prices.
Which are down.
Yep, consistently down year over year.
Yeah.
The average selling price across the GTA fell by about 4 to 5.5% between May and August compared to last year. Brought the average down closer to just over the $1 million mark by August.
Okay.
And the MLS Home Price Index, which is often seen as a better measure, that composite benchmark was also down about 5.2 to 5.4% year over year in those months. Condos specifically, the average price in Q2 was down almost 6% across the GTA.
So, okay, prices are softening. There's more to choose from. That brings up affordability.
Mm-hmm.
Is it actually getting better for people trying to buy, or is that another one of these paradoxes?
It is absolutely a paradox. Technically, yes, affordability has improved a bit from the absolute peaks last year because prices are lower and borrowing costs came down some.
Right.
But, and this is the big, but it remains severely strained. It's still incredibly challenging for a typical household earning an average GTA income. And more importantly, that economic uncertainty, that lack of confidence we talked about.
Yeah.
It's making potential buyers hit the pause button. They're adopting a wait-and-see approach. That psychological barrier, worrying about jobs, about the economy, it's just overriding the fact that on paper, things might look slightly more affordable than they did 12 months ago. People are hesitant to make that huge commitment right now.
It really sounds like that phrase, a tale of two markets, is playing out here.
Mm-hmm.
Can you break that down? How are different types of properties behaving so differently?
Absolutely. That's a key theme. There's a definite split. First, you have the freehold market, so detached, semi-detached homes. That segment seems remarkably resilient.
Resilient how?
Well, prices were described as basically flat, not falling month over month recently, and sales were actually up year over year in August for detached and semis.
Okay, why is that?
Several reasons, likely. You've got strong seller holding power. A lot of owners aren't financially stressed. They don't have to sell right now. If they're renting it out, maybe the cash flow is still decent. Carrying costs might be manageable if they bought a while ago. And there's still that underlying demand from end users, families needing space. So many owners are just staying put. It's creating this sort of frozen market feel in some segments. Buyers waiting for price drops, sellers holding term.
Right, a standoff. So the freehold market is kind of hunkering down, sturdy. How does that compare to condos? You said sales were way down there earlier.
Exactly. The condominium market feels much more vulnerable, exposed, you could say. Sales down over 20% in Q2 year over year, like we said. And remember that August data. Every property type saw sales increase year over year except condos. That really highlights the split. Condo prices are generally described as stuck. They're not really bouncing back. And a big part of this is likely oversupply. You've got a wave of new condo projects finishing up, adding units to the market. Plus, you have more investors deciding maybe now's the time to sell.
Why are investors selling now?
Well, the challenges for investors are getting pretty significant. Rents are falling, vacancies are rising. That really eats into profitability. For some, especially those who bought near the peak or are facing much higher mortgage rates on renewal, they might actually be losing money each month in negative cash flow.
Right.
And if that continues, yeah, you could potentially see a wave of investor-led selling, which would put even more downward pressure on condo prices.
Okay, so given those pressures, falling rents, rising vacancies, let's pivot to the rental market itself. What are we seeing there? Is it getting easier for tenants?
It definitely seems to be shifting more in favor of tenants, yeah. The market's softening, becoming more balanced. The average rent for all types of apartments in Q2 was down 5% year over year, around $2,617. One bedroom specifically, also down about 5% to around $2,326 on average. And the vacancy rate for purpose-built rentals in the GTHA hit 3.5% in Q1. That's the highest it's been since mid-2021.
So more choice, maybe some downward pressure on rents for tenants, but tough for landlords.
Exactly. Significant pressure, especially when you consider, like we mentioned, almost 40% of Ontario condos are owned by investors. Many of them are facing higher costs and now potentially lower income. It's a squeeze.
Okay, so we've got these market dynamics, the rental squeeze, the broader economic uncertainty. What about the government? Are they doing anything federally to tackle the housing crisis that might actually, help soon?
Well, the new Liberal minority government under Mark Carney has put forward several proposals. There's talk of a new federal agency, Build Canada Homes, BCH, to kind of oversee and fund affordable housing. They're also proposing to eliminate the GST for first-time buyers on new homes under $1 million. And they want to bring back tax incentives for building purpose-built rentals, the old MURB provision idea, plus expand the Housing Accelerator Fund to get cities building faster. And importantly, they've also revised immigration targets downwards. For 2025, the target for permanent residents is now 395,000, down from 500,000 previously.
Right.
And they're cutting temporary resident numbers too, like international students, by 10% for 2025. The idea is to ease housing demand pressure.
But could that backfire? Like worsen labor shortages, especially in construction?
That's the potential downside, yeah. It's a tricky balance. You might ease housing demand, but make it harder to find the workers needed to actually build more housing.
So lots of ideas, lots of moving parts there on the policy front. But how quickly can any of this actually make a difference? Are we talking short-term relief, or is this more aspirational?
It's definitely playing the longer game. I mean, think about it, building large-scale housing projects, reforming municipal zoning and approvals. These things just take time, years, often.
Right.
And there's bound to be skepticism about hitting really ambitious building targets, especially with those labor shortages and existing red tape. So for the immediate future, for the rest of 2025, things like interest rates, consumer and business confidence, and especially that trade situation, those are going to have a much bigger impact day to day than these new federal policies, which are still just getting off the ground. Important long term, yes, but not immediate market movers.
Okay, so what's really fascinating here is just this constant push and pull. Global trade impacting local confidence, interest rates trying to stimulate but getting blocked, different parts of the housing market going in opposite directions. So if you had to pull it all together, what's the integrated outlook for the GTA market for the rest of this year?
I think the main words are probably tepid and uncertain, lukewarm, maybe. You've got the potential stimulus from the Babos rate cuts, but it's being largely canceled out by that chilling effect from the U.S.-Canada trade dispute. It's just keeping confidence really low.
Right, that standoff continues.
Exactly. So near term, for the rest of 2025, I'd expect sales volumes to stay pretty subdued overall. Inventory levels likely stay elevated, meaning it remains more of a buyer's market. And that means continued downward pressure on prices is likely, probably gradual, not a crash, but definitely soft. And again, the condo segment looks more vulnerable there. We do expect the BOC to cut rates further, probably getting down into that 2.0 to 2.25% range eventually. That'll lower variable mortgage rates, which helps a bit. Fixed rates might come down more slowly, though, and the rental market likely keeps softening.
And just to reiterate, if there's one single thing that could really change the game, turn things around faster,
it's the trade relationship, hands down. If the U.S. and Canada manage to resolve things or even just significantly de-escalate the tariffs and rhetoric, that could be huge. It could unlock a lot of pent-up demand, boost confidence almost overnight, and really change the trajectory for the economy and the housing market.
But if it drags on?
If it drags on or gets worse, then we risk a more serious economic slowdown and potentially a deeper housing correction. It really is the major wild card right now.
So just to quickly recap that central tension, affordability looks maybe a tiny bit better on paper, but nobody feels confident enough to jump in because of these bigger economic fears, especially trade. And it's created this real split, the resilient freehold market versus the vulnerable condo market. A tale of two cities almost.
It really has. And for anyone involved, buying, selling, renting, investing, it just highlights how important it is to be strategic right now. Do your homework, understand these dynamics, and focus on your long-term goals and fundamentals. It's definitely an environment that requires careful navigation.
Okay, here's where it gets really interesting, though. Maybe a final thought for people to chew on. We've talked a lot about how these current headwinds, especially trade, are creating this frozen freehold market versus the shaky condo market, this tale of two markets.
Right.
But what if? What if this isn't just temporary? What if this divergence we're seeing isn't just about the current economic cycle? Could this actually be fundamentally reshaping Toronto's urban landscape for the long haul? Permanently changing how we think about owning detached homes versus condos, maybe even shifting rental dynamics in a more lasting way? Are we moving beyond just cyclical ups and downs into maybe a new structural reality for housing in this city? Something to think about. Thank you for joining us on this deep dive.